In the late 1990s, the internet boom created massive excitement in the stock market. Investors believed that any company related to the internet would succeed. One of the most famous examples was Pets.com. The company went public in February 2000, raising around $82 million. At its peak, its market value reached hundreds of millions. But the business model was broken. The company was selling pet food online at a loss, and shipping costs were higher than the profit on each order. Within just 9 months of going public, the company shut down in November 2000. Another major example was Webvan. It raised over $800 million from investors and built large automated warehouses across multiple cities. The company expanded too quickly, expecting future demand to justify its costs. But the demand never matched expectations, and by 2001, Webvan filed for bankruptcy. eToys followed a similar path. At one point, it was valued at over $8 billion during the dot-com boom, but it faced strong competition from traditional retailers and struggled with logistics. By 2001, it also filed for bankruptcy, wiping out investors. Now move forward to 2008. Lehman Brothers had been operating since 1850. Just before its collapse, it had over $600 billion in assets. But a large portion of those assets were tied to risky mortgage-backed securities. When the housing market collapsed, the value of those assets fell sharply. In September 2008, Lehman Brothers filed for bankruptcy. Its stock, which had traded above $80 in 2007, dropped to zero. At the same time, Bear Stearns faced a liquidity crisis. In March 2008, it was acquired by JP Morgan for just $2 per share, down from over $170 the previous year. AIG had sold hundreds of billions of dollars in credit default swaps, essentially insuring risky financial products. When those products failed, AIG faced massive losses. The U.S. government stepped in with a bailout of over $180 billion to prevent its collapse. Even companies that survived saw massive declines. General Electric, once considered one of the safest companies, saw its stock fall from around $40 in 2007 to below $10 in 2009. Now consider more recent examples. Nokia controlled over 40% of the global mobile phone market in the early 2000s. It was the dominant player in its industry. But when smartphones became the new standard, Nokia failed to adapt quickly enough. Over the next decade, its market position collapsed. BlackBerry was once the leading smartphone brand for business users. Its devices were considered essential for professionals. But as competitors introduced more advanced and user-friendly smartphones, BlackBerry lost its dominance. Its stock price fell dramatically over time. Now step back and look at these examples together. Different industries, different time periods, different reasons, but the same outcome. Companies that looked strong, dominant, and safe eventually declined or disappeared. Now imagine a different approach. Instead of investing in one company, you invest in many. This is what an ETF does. An S&P 500 ETF includes hundreds of companies such as Apple, Microsoft, and Amazon. If one company fails, the others continue to operate. Your entire investment is not dependent on a single outcome. This changes everything. Because investing is not just about finding the next winner. It is about avoiding the possibility of total loss. And history has shown that even the biggest companies can fail. That is why many experienced investors focus on diversification. Because in the long run, survival matters more than prediction. In the late 1990s, investors were chasing internet companies, believing they had found the future. One of the most talked about companies was Pets.com, which grew rapidly and attracted massive attention. But within a short time, it completely collapsed. Investors who put their money into that one company lost everything. This was not the only case. Around the same period, companies like Webvan and eToys also failed. They were once considered promising, but they could not survive. This shows the first important lesson. Even when something looks like the future, individual companies can still fail. Now move forward to 2008. Lehman Brothers, one of the largest investment banks in the world, went bankrupt. At the same time, Bear Stearns collapsed and had to be rescued. AIG required a massive government bailout. These were not small companies. They were considered core parts of the financial system. Yet they still failed, or nearly failed. Even companies that survived suffered major losses. General Electric lost more than 70% of its value during the crisis. Now consider more recent examples. Nokia once dominated the mobile phone industry. BlackBerry was also a market leader. Today, neither company holds that position. Investors who concentrated their money in those companies faced long-term declines. These examples all point to the same pattern. No matter how strong a company looks, it can decline or fail. Now imagine a different approach. Instead of investing in one company, you invest in many. This is what an ETF does. For example, an S&P 500 ETF includes hundreds of companies such as Apple, Microsoft, and Amazon. If one company struggles, the others can balance it out. This reduces the risk of a single failure destroying your investment. Over time, this diversification becomes powerful. While individual companies rise and fall, the overall market has historically recovered and grown. This leads to an important lesson. Investing is not just about finding winners. It is about surviving mistakes. Many beginners believe they need to pick the perfect stock, but history shows that even experts struggle to do this consistently. ETFs offer a different approach. They reduce the need to predict individual winners and instead focus on long-term growth. There is also a behavioral advantage. When people invest in individual stocks, they react emotionally to news and price changes. With ETFs, it is easier to stay consistent. And consistency is one of the most important factors in long-term investing success. In the end, both strategies have their place. But for most people, especially beginners, diversification through ETFs provides a more stable and realistic path. Because history does not just show what happened once. It shows what tends to happen again and again.